It's now been a little over a month since Starbucks reported their Q2 earnings report that pushed their stock price down to a 52-week low, and that earnings report was a disaster for the company. But what's been happening since then? Well, we can see as of right now, the company's trading at about $81.62 per share, and over the past year, they're down around 16.65%. And we can see where that disaster earnings report was right here. The company went from around $88 per share all the way down to around $72 per share. But if we look at the company over the past month, we can see since that earnings report, the company's up nearly 13% now. So if you bought the dip at that low, you've definitely reaped the benefits so far. But what is the long-term outlook for this company moving forward? So in this video, we are going to take another glance at that recent earnings report. We'll be digging into some of the fundamentals of the company and taking a glance at some of the recent news, and like always, seeing if we can find the intrinsic value of this stock. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials, then you can head over to tickerdata.com at the link in the description. So let's go ahead and start diving in. Now, like I said, over the past month, Starbucks is up around 12.81%. And I personally actually added a few shares when this company was trading in the low 70s. So I have seen some decent gains over the past month from this position. Now, what happened though in that recent earnings report that caused the stock price to fall all the way down to its 52-week low? Well, if we jump over to the earnings report, there's a couple of things we need to point out. First off, we can see up here, we have our Q2 North America segment results, and down here we have our Q2 International segment results. Let's go ahead and look at North America first. So here we can see things like change in comparable store sales, we can see change in transactions, and change in ticket. We have the results right here for March 31st, 2024. That's Q2 for Starbucks, and we can see the results compared to last year. Now, change in comparable store sales was down by about 3%, which, keep in mind, Wall Street was actually expecting this to be a positive number. But here's where things really start to get bad for the company. Look at change in transactions. There was 7% less transactions in Q2 of 2024. That is not good. Now, on the bright side, we can see there was a 4% increase in ticket, basically meaning customers are paying more when they come into the store. So overall, I don't think the market liked what they were seeing here, but here's where I have my concern. Look at the operating margin on April 2nd of 2023. It's sitting at about 19.1%. But if you look at where it was in the most recent quarter, it's at about 18%. Yes, that is only a little bit over a 1% difference, but that definitely makes a difference on the company's bottom line. Now, keep in mind, this was just North America. What did things look like internationally for this company? Well, if we keep scrolling down, we can see it's actually not a whole lot better. We can see change in comparable store sales down by around 6%. Transactions, there was 3% less transactions, and here's where it gets really bad, the change in ticket. While this was a positive number in North America, people are actually paying less internationally, 3% less in fact. And then here's a big red flag for the company. We can see last year, operating margin internationally was 17%, but in the most recent quarter, it dropped all the way to 13.3%. That is a really big drop. Now, one of the people who made a lot of comments on this earnings report was Starbucks ex-CEO Howard Schultz, who was wildly successful when he was at Starbucks. And if we scroll down, we can see a couple of the comments that he made. He said Starbucks really needs to start focusing on things like the customer experience and other things such as the payment platform and mobile ordering. But if we keep scrolling down, we can also see he said Starbucks will recover, and of that he is certain. He also stated that he's confident that the China business will return to health and become the company's largest market. The brand is incredibly resilient, but it's clearly not business as usual. Now, for Starbucks investors, it should give you some confidence that Howard Schultz is still confident in Starbucks and is still confident in the China business. Growth in international markets for Starbucks, especially in China, is still a huge focus for this company. So obviously, that was a poor earnings report for Starbucks, but there's still a lot of people who think this company has a competitive advantage. And in my opinion, a lot of the times competitive advantages can show up in the fundamentals of a company in two ways, and I think that's through return on invested capital and steady profit margins. So if we come up here, let's go ahead and plug in SBUX and hit enter. And you can see, thanks to the ticker data add-on in Google Sheets, all this data will automatically load in. Now again, like I said, two things you should focus on to see if a company has a competitive advantage are going to be return on invested capital, and it's going to be steady gross profit margins. And if we look at return on invested capital for Starbucks, we can see even despite some recent headwinds, it's actually been really good for the company. Now, obviously 2020 was an exception, but this is a company that operates in the food and beverage industry. Obviously, that was a pretty bad year for all those companies in that industry. But if we look at 2021, we can see ROIC of about 21%, 2022, 23.7%, and 2023, 27%. That is really high levels of return on invested capital. It means that the projects this company are investing into are really profitable. So when I'm trying to determine if this company has a competitive advantage, they definitely get a green check mark when it comes to return on invested capital. Now let's jump over to the profitability sheet. And again, what we want to look for is steady gross profit margins. And we can see the 10-year average gross profit ratio for Starbucks is sitting at about 28.5%. And again, like most companies in the food and beverage industry, 2020 was a little bit choppy. We can see it got as low as around 21.5%. So I don't necessarily take that into account, but we can see in 2021, it's sitting at about 28.8%, 2022, 25.96%, and 2023, about 27.37%. So over the past couple of years, it has been a little bit lower than that 10-year average gross profit ratio, but for the most part, looks like the gross profit ratios are staying pretty steady for this company. Now, what this chart isn't yet taking into account, though, is the operating margin decline we saw internationally and the slight decline we also saw in North America. Waiting to see if we see any improvements in these operating margins will tell us a lot about the company's future. Now, in other news, we can see Starbucks has discounted more of its popular coffee drinks in China. And based off that recent earnings report, this really shouldn't come as a surprise. Again, we can see internationally, Starbucks had 3% less transactions and also 3% lower ticket prices. So it looks like they're really making an effort to get more people internationally to come into their stores. Now, historically speaking, people have considered Starbucks a great dividend stock. And in fact, we can see that starting dividend yield sitting at about 2.8%, which is quite a bit higher than the average yield for this company. And in fact, if we jump over to the dividend yield tab here on Seeking Alpha, we can see the 4-year average starting dividend yield for this company sitting at about 2.02%. And if we scroll down even further and look at the dividend yield for this company over the past 5 years, its current starting dividend yield is pretty much the highest it has been in the past 5 years. Let's go ahead and look at this company from a dividend perspective. If we jump over to my dividend breakdown sheet, we'll come up here, plug in SBUX and hit enter. And we can see all this data is going to automatically load in. Now, like I already touched on, starting yield sitting right at about 2.8%. And if we look at the 10-year dividend CAGR for this company, it's pretty impressive. It's sitting at about 15.28%. So this company has rapidly increased their dividend payouts over the past decade. And we can see this visualized down here. We can see they've gone from about 45-cent per share dividend payouts all the way up to about $2.16. And now $2.28. So really good dividend growth over the past decade. And over the past 5 years, it's also been pretty decent, close to around 9%. Now we can see the 10-year free cash flow CAGR sitting at about 7.66%, but the 5-year is showing negative 18%. Now, why is this? Well, really free cash flow isn't declining, but we can see from a 5-year perspective, in 2018, the company generated a ton of free cash flow. It was about $9.9 billion. Now, compared to 2023 was sitting at about $3.6 billion. So there's definitely a decline from 2018 to 2023, but over a decade time period, we're still trending in the right direction. Again, 10-year free cash flow CAGR of about 7.66%. Now, when we look at the free cash flow payout ratio to better understand the safety of those dividend payments, you can see 2020 sticks out pretty bad. And again, this was a rough year for all the companies in the food and beverage industry. And we can see in 2020, the company barely generated any free cash flow, about $114 million. But when you compare that to the amount they paid out in dividends, they paid out about $1.9 billion in dividends. So obviously the free cash flow payout ratio is going to look pretty bad in 2020. But for the most part, we can see free cash flow payout ratio as of 2023, about 66.17%, and payout ratio as a result of earnings, close to around 59%. Now, to be honest, for a company like Starbucks, I'd actually like to see it a little bit lower than this. I think this is a little bit higher than I'd typically like to see for a company like Starbucks. For me personally, I'd like to see them get back to around 2021 levels when their free cash flow payout ratio was a little bit below 50%. Now, with all this being said, is Starbucks a good company to consider adding to your portfolio at $81.60 per share? And to answer that question, we're going to jump over to my stock valuation spreadsheet. Again, we'll come up here and plug in SBUX and hit enter. And again, the data will load in. Now we can see Starbucks has a beta sitting at about 0.96, so the volatility should follow that of the market pretty closely. Now the first valuation we'll glance at, we'll go ahead and look at Graham's valuation. And again, this values a company based on the earnings per share, the growth of those earnings, and current market conditions. And we can see we have our estimated earnings per share average coming in automatically via the ticker data add-on. And apparently analysts are estimating about 3.6 earnings per share on average. Now the growth rate projection for this company is still relatively high. We'll see if that remains true. But what is really driving down this valuation is going to be the current yield on AAA corporate bonds. That's current market conditions. It's sitting at about 4.89. So when we apply all of this into our formula, we come to an intrinsic value of about $68.02 per share, which is a decent amount lower than that current share price. Now if we jump over to our discounted cash flow analysis again, let's go ahead and zoom in just a little bit more. We can see growth rate projections for this company's free cash flow have been a little bit lower over the past few months, now sitting at about 10.5%. So after adding the company's cash and cash equivalents, subtracting total debt, we get equity value, divide by shares outstanding, and we come to a DCF price per share of right at $82. Now, if we go over to our multiples valuation, again, this values a company based on how the market is valuing companies that are similar in structure. So we have companies like McDonald's, Yum Brands, Domino's Pizza, and the price to earnings multiple for these companies is actually relatively high, as we can see here. The average PE for these companies is sitting at about 27.22. So if we apply that same price to earnings to Starbucks at 3.6 earnings per share, we come to an intrinsic value of $98. So again, looks like compared to their peers, they're a little bit undervalued. Then finally, if we jump over to our dividend discount model, we'll zoom back out just a little bit. This values a company based on how much they're paying out in dividends and how much that dividend will increase over time. And we can see the past few dividend increases for the company have been decent. We have 9.5, 8.7, 8%, and about 5.5%. Moving forward, I'm projecting a dividend growth rate of 6%, and with a discount rate of 8%, we come to a dividend discount model price per share of $120.84. That is quite a bit higher than that current trading price. And if you'll keep in mind that 5-year dividend CAGR still sitting at about 8.8%. So as long as free cash flow again can be around 7.66% again over the next decade, I think the dividend discount model will prove to be true, that they can attain a 6% dividend growth rate. So when we jump over to the output tab, we can see our 4 valuations put together. We have grams, multiples, DCF, and dividend discount model averaged together to give us $92.21 intrinsic value. Now the current trading price for the company is sitting at about $81.60. So with a 10% margin of safety, you could see our acceptable buy price sitting at about $83 per share, and with a 20% sitting at about $73.77. And this is actually pretty close to the price that I added a few shares to my portfolio around a month ago. So overall, like the ex-CEO Howard Schultz pointed out, there's definitely some problems Starbucks has to address moving forward if they want to be successful over the next decade. Like we saw in the earnings report, people seem to be going to Starbucks even less. And in the case internationally, they're actually spending even less when they're going there. So I think there could still be potential headwinds for this company over the short term, but long term, I think this is something they can get through. Again, I agree with Howard Schultz's comments. I think Starbucks will recover, and I still think they have a lot of growth that they'll see in the China market. So personally, I was happy to add a few more shares to my portfolio in the low 70s, but right now I'm not planning on adding any more. So go ahead and let me know what you think of Starbucks in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.